Welcome to Lesson 2 series, where we are going to learn about the basics of the stock market. I'm your teacher and mentor, Mntom'nyama. In this video and other parts to come, we are going to talk about the key variables and concepts that every investor must know in order to play the game of investing in the stock market. The knowledge you will gain will help you to lay a solid foundation upon which you will begin to understand how the stock market works. So without further delay, let's get going. The first question to ask is this: what is a share of a business? A share of a business of stock represents a piece of a business that is for sale at a particular price. This means that when you buy a share of a particular business, you are paying to gain ownership of a certain portion of the company. You become the shareholder of that business, and therefore you are entitled to share in its profits. Remember the basic principle of investing. We want to invest our money in businesses that are doing well. We do this because we want to make money, isn't it? It's logical to say then that a business is a money-making machine. The more it does well, meaning the more money it makes consistently over time, the higher the value of that business, and therefore the higher the value of the shares you are holding. So the important thing as investors is to focus on the business itself. Is it making more money year after year? If so, then the value of your shares will be worth more money over time. That is as basic as it gets. You also have to learn to ignore and not get distracted by the noise happening all around us. By that, I mean negative global events such as wars, high interest rates, high inflation, recessions, media hype and scare tactics, predictions made by so-called gurus, and so on. Of course, in the short term, these events can cause short-term volatility in the markets. But in the long run, all of that is not so important. Why? Because great companies will continue to make money in the long run, despite short-term volatility and negative global events. Hope you guys get that. Now, before buying shares, one first has to know how many shares has the business issued or made available in the open marketplace. These shares would be owned by big institutions such as banks, mutual funds, hedge funds, etc., and also by individuals such as retail investors like you and I. So let's look at an example of what I am saying. Let's assume we have company AA. Company AA has 100 million shares outstanding. What does shares outstanding tell us? It tells us that the company is divided into 100 million pieces, sort of like a pizza that has 100 million slices. You can decide to buy one slice, you can buy 100 slices, you can buy 10,000 slices, and so on. In this example, let us assume that you have bought 1 million shares of company AA. If you divide 1 million by 100 million, what do you get? You get 1%. So that means by buying 1 million shares of company AA, you now effectively own 1% of the business. And because you own 1% of the business, you get 1% of the profits of the business, and you get 1% of the vote. Okay? I hope you guys get that. Then the next question to ask would be, how many shares can I buy? Well, in South Africa and the US, there is no minimum amount. Investors can buy as little as 1 share of a business. In fact, there are certain brokers that allow you to buy a fraction of a share. For example, you can buy 0.1% of a share or 0.2% of a share. This is normally catering for investors who cannot afford to buy the full share, right? Take note, however, that in many Asian countries, such as China, one has to buy a minimum of 100 to 500 shares. And that share bundle is called a lot. Moving on, before investing in a business, you first need to know the following. Number one, how much does each share cost? That's share price. Number two, how many shares are there in a business? That is shares outstanding. Number three, what is the total market value of the business? This is known as market capitalization or market cap. Number four, and one also has to know how much profit the company is generating. This is normally reported as earnings per share. Sometimes earnings per share is called net income per share or profits per share. They all mean the same thing. So where does one get this information I have just mentioned? There are plenty of websites that report this information for free. In this instance, I will use the FinViz website to get this info for Microsoft, which has a ticker symbol MSFT. So what do? We navigate to the website. You go to your web browser, you type in FinViz MSFT, which is a ticker symbol for Microsoft, and then you press search, and then the link that will take you directly to the FinViz website will appear. You click on it, and there you have it, the FinViz website with all the information you need on Microsoft. You can see the current share price of Microsoft is $374.96 per share, right? So that's where you get the price per share. At the time of recording, the share price was $373.26 per share, and that is the figure we are going to use. But now it has changed to 374.96 because this changes regularly on a daily basis. So where do I get the total shares outstanding? Well, you scroll down and you can read off shares outstanding, and you can see for Microsoft, the number of shares outstanding is 7.43 billion. Okay, so we take these two numbers. We can use these two numbers to calculate the market cap or market capitalization or the market value of the business. The market cap equation is price per share multiplied by shares outstanding. So we said the share price is $373.26 and the shares outstanding is 7.43 billion. So multiplying these two figures gives us $2,773 billion. So if you wanted to buy the whole of Microsoft, you will have to pay $2,773 billion. Okay, but you don't need to calculate this figure. It is already given to us. So we go back to the FinViz website. You can see market cap or market capitalization. You can see it's 2,786. It will be different from the one you calculated because of the different share price. But currently, 2,786.8 billion is the price you would have to pay in order to buy the whole of Microsoft. Okay, now we move on to the next important variable, which is called earnings per share. Okay. When you buy into a business, you want to invest in a business that is making money and generating profits consistently year after year. We track this using a variable called earnings per share, which is calculated as follows. Earnings per share is equals to total income divided by shares outstanding. So how do we get this total income figure? Well, we go back to the FinViz website. It tells us what the income is. And currently, Microsoft has an income of $77.1 billion. So we take this figure, we plug it into our equation, we divide it with the shares outstanding, we get earnings per share value of $10.33 per share. All right. So what does this figure tell us? What does it mean? It means for every share of Microsoft I own, I am entitled to receive $10.33 in profits. Okay? These are profits that have been generated in the last 12 months. For example, let's say I had 100 shares of Microsoft and the earnings per share is $10.33 per share. So you multiply these two numbers, I get roughly $1,000. So it says because of my 100 shares, I will get $1,000 in profits. Do you guys get that? I hope so. But this figure of earnings per share, you don't have to calculate it either. It's already given to us. So we navigate back to the FinViz website. You can see that the EPS or the earnings per share TTM is $10.33 per share. All right. So what does TTM stand for and what does it mean? TTM means trailing 12 months, which means the figure displayed is based on the last 12 months of profits. All right. But now, in reality, this is not how companies pay back their shareholders. An investor will not get the $10.33 as a direct cash profit. Instead, businesses reward their shareholders in various ways. Let's outline the 4 common ways shareholders share in the profits of the business. Number 1, through cash dividends. Some companies will pay parts of their profits every year through cash dividends. Number 2, they reward their shareholders through share buyback. Some companies do not pay out cash dividends. Instead, they reward investors through share buyback. Share buyback is when a company takes its profits and uses this to buy back a certain portion of its own shares in the open marketplace. Once bought, the company takes the shares out of circulation and effectively cancels them. These shares no longer exist. This reduces the number of shares outstanding, which is good for us as shareholders of the business. But why is that a good thing? Well, because now there are less shares outstanding and therefore you share the profits of the business with less people. In other words, your slice of the pizza has become bigger. Your shares are now worth more without you having to do anything. So let's look at an example to illustrate what I'm talking about. Let's make it an extreme case for the sake of clarity. Let's assume Microsoft buys back 50% of its own shares. All right, 50%. Now, in reality, a company will not buy 50% of its shares. It may buy 3 up to 5%, but never 50%. We're using this 50% just for clarity, okay? So we know, we calculated in the previous slide that the earnings per share was $10.33. That's before share buyback. Now, Microsoft buys back 50% of its shares. So how many shares are remaining? You take 7.43 billion, you divide it by 2, you get 3.72 billion. So now there are only 3.72 billion shares outstanding, which is half of what it was before the share buyback. So we plug it into the equation. We assume that the total income remains the same at 77.1 billion. We divide by 3.72 billion, we get $20.73 per share. So you see now effectively the earnings per share has doubled and your shares are now worth more. In other words, each share you own is now earning more money. This is called capital gains, and that is how we accumulate and compound our wealth as investors. You may also ask yourself then, after share buyback, what happens to my ownership of the company? Let's look at the example of company AA. We said that as an investor, you bought 1 million shares and there are 100 million shares outstanding. You plug these numbers into the equation, you get 1% as we did previously. But now, after share buyback, there is only 50% shares remaining. The other 50% has been taken away and cancelled. So now instead of having 100 million shares in circulation, you now have only 50 million shares in circulation, and you divide your 1 million shares by 50 million, you get 2%. So your stake in the company has also doubled and you haven't even done a thing. Okay? That is why, as investors, we love it when the company buys back its own shares, because it automatically increases our percent ownership of the business. This is one of the most tax-effective ways a business returns excess cash back to its shareholders, as opposed to just giving it out as a cash dividend, which is not as tax-effective as share buyback. But there is a precondition to this. A company should only buy back shares if it is doing well. In other words, it's generating cash year after year, and if those shares are undervalued. If the shares are not undervalued and the company is not doing well, it is not advisable for it to do the share buyback program. Get that? I hope so. Let's move on to the third option, which is reinvesting. The third way a company returns profits to its shareholders is by taking these profits and then reinvest them back into the business. This creates more revenue for the company. For example, the company may take the profit and create new products and services, can invest the money in other businesses, or it can use the money to expand to new markets so that they can generate more revenue. All this, in turn, increases the value of the business because it creates more revenue streams and more profits, and hence it increases the value of the business even more. As the value of the business increases, the share price also increases, making our shares more valuable, all right, and making us richer, which is what we want. So, which is better, for a company to simply give you profits in cash for you to reinvest it yourself, or for the company to reinvest the profits on your behalf? I always prefer the business to reinvest the profits on my behalf, but my requirement is for that business to be more effective than I am in growing the profits. So how can I tell that the business is efficient in deploying my profits? I look at a figure called return on invested capital, ROIC. So where can I find this figure? Well, we can find it in a website called Guru Focus. All right, we navigate to Guru Focus. And there you go. We are in the site, and it's called Guru Focus. And we read off the ROIC for Microsoft is 26.09%. So what does this 26.09% mean? This means that for every $1 of profits that the company keeps and reinvests internally, it is able to grow my money at a rate of 26.09%. So if I can't get a return of 26.09% if I reinvest my profits on my own, then it is better for Microsoft to do the work for me. That is why I only invest in companies with an ROIC of greater than 12 to 15% or even higher, because these businesses can grow and compound my profits more and more, which will ultimately cause the share price to rise and hence make my shares more valuable. I hope you guys get that. We move on to the last and least desirable option, retained earnings. So the fourth thing a company can do is to just keep your profits in cash as retained earnings. This is just a piggy bank where the company just takes the profits and put it in a cash reserve and leaves it there. And then one day when you want to cash in on your shares, the company will pay you out from those cash reserves. This is the least desirable option. All right. So in conclusion, and to summarize everything I've just said, remember this: when you buy shares of a business, you are buying rights of ownership to that business and its profits. We said a business is a money-making machine. The more money it makes, the more valuable the company becomes. As a shareholder, you are entitled to the profits of the business every year. These profits are expressed as earnings per share. Companies distribute profits to shareholders in 4 different ways: through cash dividend, through share buyback. The company can reinvest the profits for you to grow the company. And lastly, they can just retain your earnings in cash reserves.